In the past, I have talked about how to value your company if you're raising a pre-seed round on a safe. I've talked about if you are a fresh founder, haven't really been in tech, haven't really been in this world, you should probably raise on a 2 or 3 or 4 million post money valuation. If you have some exposure to tech, you've been an employee at a tech company, you have a little context, maybe you raise at a 4 million, 5 million, 6 million post money valuation. And if you're a superstar, you just exited a company, you have a great background, maybe you raise at a, I don't know, 6, 7, 8, 9, 10 post money valuation. Maybe more if you want, but I wouldn't suggest it. With that said, everyone picks a number they want to start at, but that number isn't real until there's an investor on the other side of the table that says, this is real. I think you are worth this amount of money. Here is a check. It is all fantasy to a founder to say, oh, I'm worth $5 million. Oh, my company's worth $7 million. Oh, we'll be super easy to raise. We're just going to make our company worth $3 million. None of it matters until you have an investor that agrees and is willing to sign and wire. So this is why there is some tools that a founder will need to kick a fundraise off. One of these tools is around tranching a raise. Let me give you an example. Let's say you want to raise $1 million, and let's say you want to dilute 20% of your company. So effectively, that would mean a $5 million post-money safe. Okay? Well, in a perfect world, you raise all the money at a $5 million post-money safe, and you go off and you have your million, the investors have their 20%, and it's all great. But there's a good chance that investors may think 5 million is too high. And there's also a good chance that you don't want to dilute more than 20% of your company, right? So what happens here? These are two conflicting truths. Well, the reality is what happens here is you just make your company more enticing to investors who invest earlier versus later in the round. And this is called the tranche strategy. What this looks like is instead of telling investor A that you're raising at a 5 million post money, before you've raised anything, tell them, hey, I value that you're looking at this as a first investor in the company, and I'm open to having you involved at a 3 million post money if you want to invest. And let's say this investor wants to invest $250,000. Okay. Then they say, great, this is wonderful. I'll invest 250K and I'll get a great deal, and this is great. Now you might be wondering, okay, well, we're not raising the rest of this round at 3 million, or we're just gonna stop the fundraise at 250. So what are we doing here? What we're doing here is we're de-risking your company. If I'm an investor and I look at a company, they say they're going to raise $1 million, they raise nothing. The odds that I believe they're going to raise any of it are very low, right? Versus if I see a company, I see they've already raised $250,000 from a credible investor, and they're on their way. I believe a little more they may raise the rest of the round. It's just investor psychology, right? So because of this, and because just on the balance sheet in the bank account that the company has 250 grand in the bank account, I think the company is a little de-risked, not totally de-risked, but a little more de-risked than before that 250K check. So maybe if you're a founder, you go to the next investor and you say, hey, Mr. or Mrs. Investor, we're raising $1 million. We are raising 250K right now, if that's your average check size, at a 5 million post money. Is that interesting to you? And like I said, the investor may look at the information, may look at the team, may look at the founders and the traction, look at your cap table and say, 5 million, I would have preferred to play lower, but I think there's something here, and I respect and appreciate that I'm not taking the risk as the first investor. I'm going to invest. And they put in 250. So what do you have here? You have a 250K check at a $3 million post money valuation. You have a 250K check at a $5 million post money valuation. It's not it's not $1 million. You have more room to dilute, but you can't raise the rest of 5 million. What do? Well, you look at the math and you say, what I already have 2 investors that invested on this tranche strategy. What if we crank it up just one more notch and raise the rest of the money at a 7 million post money valuation on a safe? And in this case, because it's a higher valuation, you would raise the rest of the round, $500,000 at a 7 million post money. What happens is an investor sees your company and they say, oh, wow, like you got 2 investors. This round feels like it's moving. 7 million feels cheap. I'll invest. Here's 500K. And then all of a sudden, what do you have now? You have a 250K check at 3 million. You have a $250K check at 5 million. You have a $500K check at 7 million. What does that all round out to? It's not perfect, but within a 1/10 of a percentage point, maybe a 15th of a percentage point, you get $1 million that net your investors 20% of the company. What would have been the same as someone investing in $1 million at $5 million cap. Specifically, if I pull up my chart here, this will mean will have effectively raised at a $4.89 million valuation overall, which means the amount of equity that your investors get, let me just find the final number, is going to be 20.47%. So it's not perfect math. It's not perfect. But diluting 20%, 20.47% versus diluting nothing because no one's raised is a great improvement on raising nothing, right? So what are we saying here? This is the tranche strategy. I should have mentioned this earlier, but this is something I learned from Elizabeth Yin at Hustle Fund. She's a GP and co-founder of Hustle Fund. And the idea is your company looks different when you've already raised and have momentum than when you haven't raised yet. And the investors that invest first, earlier, should be rewarded for their risk. They should be rewarded by being the early investor with a lower valuation, a lower cap specifically. A few words of warning about this strategy. This is not something I would do if you're raising millions and millions and millions of dollars, or dare I say, tens of millions of dollars. If you're raising $10 million, I would not raise on safes. I would get a priced round from an investor, in my opinion at least. In addition, if you are doing a priced round, this doesn't work. This only works if you're controlling the price essentially via the safes. But in general, you can get what you want by bending a little bit and understanding investor psychology. An investor may think your company at 7 million post-money valuation, when you've already raised 500K, is worth so much more than your same company, same team, same traction, same product, at $3 million without anyone it has invested. Okay? This is investor psychology. So learn to understand it and leverage it, wield it, so you can get what you want, which is that money, right? Which is that ownership that you're going to give investors that no more than you prefer to give. Then you can go back and build your company. Okay, this is the tranche strategy, excuse me. I learned this from Elizabeth Yin. Thank you, Elizabeth. And I hope this is helpful. I hope that if you're a founder that you just can't get your first check at the valuation that you want, do the math, plug it into ChatGPT. How can you lower your valuation? Get one check in, just get one check in, then raise it. Don't raise it 7 times. Raise it 2 to 4 times maybe. Just get one check, build some momentum, de-risk the company, then raise the cap, get that money, lower the dilution of your that you let introduced into the company, give investors what they want, and then go build what you want to build. And then raise the price round for the next round so you don't have to deal with any of this, right? My name's Matt Sherman. I help founders raise capital. I advise founders on it, and I invest in founders too. You can learn more about me at mattcapital.xyz. If you like this video, if you're watching on YouTube, give it a thumbs up, give it a comment. Feel free to subscribe. If you're watching somewhere else, give me a thumbs up if that's an option. If it's not an option, just give me a thumbs up in general. I will feel it in my heart. Thank you for watching, and I will see you all next time.